Today we will be looking at your question 2, which is financial indicators and cash flow statement. So getting right into the video. Question 2 says financial indicators and cash flow statement, 40 marks in 30 minutes. So 4 statement or reports are provided as options in which of the following items would appear. Choose the financial statement or report and write only the letter A to D next to the question numbers in the answer book. Right, so we're only given 4 options and we're given 3 questions here. What we're going to say on 2.1.1 it says verbal explanation of the activities of a company for the past year. So this should go into your director's report. As you can see, it does not match any of this because your cash flow statements that's where you know you record your cash transactions. And then on B there is statement of comprehensive income. It doesn't go there. So verbal explanation, it's wording, not numbers. And all of these 3, they include numbers in them. Right. So 2.1.2 says bad debts recovered. So that's supposed to be your income. It goes into your statement of comprehensive income, which is B. And then 2.1.3 says net book value of fixed assets. That's where you find your assets, and liabilities, and all your equity is your statement of financial position, which is C. Cool. So let's fill in our answer book. So it's D, B, C. And then moving on to the next question. It says calculate the following financial indicators on the 29th of Feb 2020. We're supposed to calculate the debt equity ratio, your earnings per share, and your dividend payout rate, also your percentage return on average equity. So let's just start by identifying the formulas for these ratios. So the first one being your debt equity ratio, we just say it's your non-current liabilities. I'm just going to say that. And then it is your shareholders' equity, your SHE. And then your earnings per share would be your net profit after tax over shares issued. So if you want to state it in cents, you can just simply multiply by 100 there. And then your dividend payout rate should be your shares. Okay, let me just say dividends for the year over your earnings per share multiplied by 100, because this is a rate, it's supposed to be a percentage. Cool. So your percentage return on average equity, now you have your net profit after tax. Sometimes they can say net income after tax, right? And then you have your average shareholders equity. That's your SHE. Okay, so let's get into the calculations now. But before we do so, we are supposed to look at our information. The first one, we're supposed to calculate our debt equity ratio. So what we need is our non-current liabilities, which will be the loan, right, for this year on the 29th of Feb 2020. Don't forget. So it's non-current liabilities as to your shareholders equity. All right, so we're just gonna use those numbers, and it's going to be 900,000 is to 8,900,000, and these numbers are so big, 980,300, right? 980,300. Okay, so it's always being 2 1, and then you can calculate. So let's quickly get the calculator and see what we get. Right. Divide by 980,300. So I'm getting 0.1. So it's 0.1 is to 1. Right. So now your earnings per share. Remember we said your net profit after tax over your shares issued. So we're supposed to look at two pieces of information. So here is your net profit after tax. That is simple. That's 968,800. Let's just start by identifying that. 968,800 over the number of shares that are issued. So your share capital, here we are given information. It says information D, share capital. On the 1st of March 2019, the ordinary share capital comprised of 800,000 ordinary shares. A further 200,000 shares were issued on this date. On February 2020, the company repurchased 90,000 shares at 81,000 above the value of the shares based on the average share price of 9 cents per share. These shareholders qualified. This is very important. They qualified for final dividends. Okay, so what most of us would do at first would be, would say, okay, so there were 800,000 ordinary shares and then a further 200,000 and then we subtract your 90,000. So let me just make this simple here. So it could be 800,000 minus your 200,000. It's a plus and then minus 90,000. This would be incorrect because these shareholders, they qualified, hence they did earn a piece of the profit. So we can't exclude them when you're calculating. So the total number of shares issued for the number of shares that did get earnings is supposed to be 1,000,000 shares, because if you add these two amounts, they will give you 1,000,000. So we're just going to divide this by 1 million, right? So we can multiply by 100 to get cents. Let's see what that gives us. So it's 968,800 over 1 million times 100. Okay, so that's 96.9. So that's 96.9 cents. So if you're feeling like you want to round off, you can just say 97 cents. But I'm just gonna write the answer I got from the calculator. So that's 96.7 cents. Right. Now your dividend payout rate, it is your shares that were issued, not shares that were issued, but your dividends that were given to your shareholders throughout the year, which include your interim plus your final. So these were given to our shareholders. So it's 28 plus 12, which gives us 40. So you can simply write 40 over what did they earn? 96.9. Right? So that should be multiplied by 100 because it's a rate. And then if you calculate that, we get 40 over 96.9, which is multiplied by 100, which is 41.28%. Okay, so I'm getting 41.28%. Okay, so you can even round it off to one decimal place just for simplicity's sake, and just say 41.3. 41.3%. All right, and then your percentage return on average equity. So it's your net profit after tax, what we got from our net profit after tax, which is it's 968,800. Right, it's 968,800 over your average, which is multiplied by half, and then you take both amounts. You show this equity of 980,300 plus that. It's 8,980,300 plus 7. Let's just check what that amount is. 7,411,500. All right. So now you just simply calculate. Don't forget to multiply by 100. Let's see what that gives us. Quickly tap into your calculator. So it's a half. That's 8, 980, 300 plus 7411, 500. Then you just give it 100, and I'm getting 11.82%. So one decimal place, 11.8%. Right, so now we are moving on to the next question because we've calculated all our financial indicators. And the next question talks about completing our cash flow statement on the 29th of Feb. And then now all cash outflows must be shown in brackets to earn full marks. Okay, so the first thing that we are calculating on our cash flow statement on the 29th of Feb. Okay, let me just show that we are not supposed to give any amounts on these blocks because it looks like they are shaded. Of course they are, but they're not really visible here. Okay, so these are the 4 blocks that we're not supposed to answer. Right, so the first thing that we're supposed to calculate here is your income tax paid. So your income tax paid, when you move to the information here, we are given information that shows that information that SARS income tax was at 23,800 when we're opening our books. And what's important is that it was on the credit side. Right. Now, when we were closing our books, we had a balance of 4,500 on the debit side. So what this means is that, remember that your SARS income tax is a liability. Okay, so it increases on your credit side. Now, if it increases on a credit side, which means we simply opened with a balance of 23,800, and then we closed off with a balance of 4,500, right? So the simplest way I can show you guys to do this is using the table form. Either way, whatever way you're comfortable with, but the easier way to do this could be this way. So I say taxation paid, and it's pretty much quick. So it's always an outflow. You know that you should get an amount that is negative at the end. So now you have balance at start. Right, so it was 23,800 if I'm not mistaken. Let's just rectify. Yes, 23,800 on the credit side. What does that mean? If it was on the credit side, we were owing SARS. Remember, it's a liability account. If it's on the credit side, we are owing SARS. And at the start, it's going to be an outflow because we have to pay SARS this amount that we were owing to SARS. Right. So now your income tax. This is the income tax that you incurred during the financial year, which is this one that you are calculating on your income statement, which is 415,200, right? So this one will always be an outflow. It will always have brackets with it. It's 415,000. Cool. So now you have your balance at end. And then your balance at end, you check, okay. So the balance at end is on my debit side. Now, if it's on my debit side, that simply means I paid SARS more because now SARS owes me. Okay, so if it's on your debit side at the end, it is automatically an outflow because you paid SARS. This is all about payments, right? So now your final amount at the end, it's you just simply add all these numbers because they're negative, and then you get the final negative answer, which happens to be, okay, let me just quickly add that up, which is it's 443,500. Okay, let me check if that is really correct. Okay, that's 4,500. It's 415,200 here, which means I made a double mistake. It's 415. 200. Okay, let's rectify the calculation once again. Okay, so it's 23,800 plus 415, 200 plus 4,500. Oh, okay, that was actually correct. I punched the correct thing in the calculator, but it was an error here. Okay, my bad. Sorry about that. All right. So then we continue. We move on to what we're supposed to calculate next. Okay, so we can just simply take our calculation here. You can say 23,800. You can even write all these numbers as positives now because they are all negative. But remember that it is an outflow, so your answer at the end has to be an outflow with brackets. So plus 4,500. Right. So now we're calculating our fixed assets purchased. And then when you see your fixed assets that were purchased, it's just going to be an amount that you're not given. It's basically a balancing figure. So your fixed assets at first you had, okay, let's just work on the space. At first you had fixed assets of 8. Okay, let's use a different color. So of 8,320,300, and at the end you had a closing balance of 9,528,300. So let's work that out. So your 9,528,300 is equal to your 8,320 300 plus what you have added, what they want, your fixed assets purchased, which is X, you don't know, minus your depreciation, because this is your carrying value. There has to be some depreciation. 234. Okay, and then we are given some information on fixed assets, which says old equipment was sold at a carrying value of 48,000 minus 48,000. Okay, so we sold. Now, simply solving for X, let's see what we get. Let's just take all these amounts and take them to the other side and change their signs, and that's how you can simply solve for X. All right, so let's see what we get there. We subtract a 320 and 300, a 320 300 plus 234 plus 48,000, and that should give there's a 0 here, so that should give 1 million. Okay, X being equal to 1,490,000. Okay, so let's just rectify that the amounts are indeed correct. So we had a closing balance. Okay, this is the opening balance. This is what you purchased. Not really what you purchased, but your extensions to the buildings. Okay, so now you have 234, which is your depreciation. Okay, that's correct. And then you had your 48,000 of what you sold. So it's 1,490,000. So that's what you got for your fixed assets. Okay, we can just simply take this calculation and move it down. Okay, there you go. So it's an outflow. It's 1,490,000. It's an outflow because we purchased fixed assets. Let's get that to be neat. Okay, because it's supposed to make sure that everything that you write is clearly visible for the market to award you all the marks that you deserve. Okay, so these are we given. Now we go to your cash effects of financing activities. So your financing activities is the money that you use to fund the business. Okay, so that includes your loans, your proceeds of shares issued, repurchasing of shares, and so on and so forth. So cash effects of financing activities. I keep on saying financial. All right, so we're going to do proceeds of shares issued now. So your proceeds of shares issued, you're not given any information about any amounts of the issued shares. So you can simply use your balances on your what's this, your ordinary share capital. Okay, so you had a balance at start of 7,200,000. All right, and then you added plus X because that's what you issued, and then you had your okay, I'm supposed to subtract that, your shares that you repurchased. Remember, so the shares that you repurchased, they were at 910 on your average share price. Okay, they were valued at that, so it's gonna be 910. Did I say 910? Sorry for that mistake. It's 910 cents. Okay, so it's 910 cents multiplied by 90,000 average, 90,000 shares. Okay, so from there you are going to get your final figure of 8281,123, and then you just keep on solving for X. All right, so 72 plus X. Okay, let's just get an amount here. What this amount is, 910 cents times 90,000. So that's 819,000. It's 8281. Okay, so you can just simply let's just do this. Okay, proceeds. Okay, so it's proceeds of shares issued. Remember that we had your 7,200,000 minus your X. It's a plus X minus 819,000 being equal to, what's that final amount? I'm not seeing it. Okay, it's 8281. Right, it's 8281. Now we can simply solve for X, which will be, okay, so if we solve for X, I'm getting 1,900,000. Okay, so it is not an outflow, it's an inflow because we issued shares and we received money. Right, so you can even show your calculation where you solve for X and so on, but that is just gonna waste our time. But it is really important for you to show how you solved for X. Okay, so for the sake of just showing, we can say 281 minus 7,200 plus 819. Okay, so what's really important now is the calculation. Okay, so let's just show it there. Right, so your answer is 1,900,000. And then now your funds used to repurchase shares. What did we use to repurchase shares? Let's see what they're telling us. It says, on the 29th of Feb 2020, the company repurchased 90,000 shares at 81,000 above the value of the shares, based on the average share price of 910 cents per share. These shareholders qualified for final dividends. So the average share price is 910 cents. All right, so we use that amount. It's 910 cents times 90,000 shares plus what we paid over and above the average share price, which is 81,000. So we're just gonna add these two amounts, and okay, let's see if that is really correct. 910 cents times 90,000 plus 81,000, And that should give you an outflow of 900,000. All right. And then now, when you're looking at your financing activities, what is left out are your change in loans. Remember that we use loans to finance our business. We use loans to have money in our business. So here we have change in loans, in loan or in loans. Okay. If they have multiple loans, it's just going to be loans. Now, when you look at your loans, let's use this one. If you look at your loans, your loan was 900,000, or was 1,200,000, and now it is seated at 900,000. Cool. So it looks like our loan decreased from this amount to that. So we paid a portion of our loan, which happens to be 300,000. So our loans decreased, and that simply shows that we paid 300,000 in our loan. So it's 1,200,000 minus 900,000. All right, so that's your calculation. It's an outflow. So now your net change in cash and cash equivalents. Okay, before we get to that, because we are going to be looking at these two amounts in order to simply get our net change, let's just first look at your cash on your opening balance. All right. Now, when we look at our information, we are going to find that at our opening, we had cash and cash equivalent worth 5,000, but we also had a bank overdraft of 220,000. So our bank overdraft will decrease our cash and cash equivalent. So we had 5,000 minus 220,000. Cool. So there we are going to get a negative balance of 215,000. All right. So now our cash closing balance, that should easily be your 56,500 because we don't have anything on our bank overdraft. So it's going to be 56,000. Oh, it's 56,500. 56,500. Now, getting your net change in cash and cash equivalent would simply be getting the difference between these two amounts, because that's the total change. It's basically asking what was the change from when your books were opened and now when you're closing your books. So the difference there should be let's see. So it's negative 215 minus 56,500, which is 271,000 271,500. Right. So that concludes our question today. Thank you so much for joining me when doing this question. I hope it was really productive and you got the help you deserved. Don't forget to subscribe, like, share, and comment. It will really help with the creation of more content. Thank you once again for watching. I'll see you in the next video.